Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Long ago and far away, folks, a guy named Ferro was at Merrill Lynch with Rosenberg, and between the two of them, it was 2 required reads every week. And with Rosenberg, on page 3 or 4, it was a vertical column slicing and dicing inflation like no one on the street. Absolutely no one did it or does it like David Rosenberg. David, what is the character, the nature of our disinflation?
Well, inflation, like any other price, and of course inflation is a change in prices, not the level, always going to be dictated by the shape of the demand and supply curves in the economy and how those curves are moving. So, what we're seeing happening, and especially in the labor market, is those demand and supply curves are moving in a decisive disinflationary pattern. And so that's what I'm looking at right now, just how these demand supply curves are shifting. And as I said, They're shifting away towards lower wage inflation and price inflation in general.
Some people don't know where those curves are. Some people look at them as a Marshallian cross. What I'm going to suggest to you is that's not true, and that there are times where accelerative tendencies or convexity can move as supply moves or demand moves. Are we at a point where we get jump conditions and disinflation to a much lower set?
Well, the best way I can answer that is almost to paraphrase what G. Powell said at the podium after the last FOMC meeting, where he said that recession is not the Fed's base case scenario. He's not concerned about a collapsing economy. But he talked incessantly about the widening slack that we're seeing in the labor market. And that's ultimately going to be one of the key elements behind any inflation or disinflation. So it's very interesting that while he remained a bit of a cheerleader for the economy, he's noting that they're getting more comfortable, getting more confident over the disinflation. But the emphasis on slack emerging in the labor market, to me, was very key. And I think that what he's really signaling here is that we are seeing, and whether it's because the productivity numbers have consistently come in better than expected, and the immigration boom that supported population growth and the labor force participation rate, that we've had a shift in the supply curve, even as demand has hung in. Now, demand growth isn't what it was, say, 12, 24, 36 months ago with all the stimulus, but demand growth is holding in. But we have a situation where perhaps demand growth is running at, say, 2.5% on a trend. But what if that's bumping against a supply curve that's closer to 4%? So all of a sudden, what we view as real GDP growth, which is the proxy for aggregate demand, what looks like 2 to 2.5% today, benchmarked against what the supply curve is doing in the economy, is almost what zero was, say, 10, 20, or 30 years ago. So that's really what's important here, is that we're seeing a widening gap between the growth in aggregate demand benchmarked against aggregate supply. Right. And that's why, without a recession, you've had core inflation. For all the talk about sticky, core inflation's come down in the past 12 months by 150 basis points.
David, Paul Sweeney, we're at 7:08 a.m. Wall Street time, and our heads are breaking over price theory with David Rosenberg. But the answer is, all of the foreign affairs article on China, there's a lot of supply out there.
There's a lot of
maybe that's what's bringing the prices down.
A lot of supply out there. David, what's the labor market telling us about this economy here? I mean, the market really got freaked out a week ago Friday about some of those labor data.
Well, I don't think that, the stock market as a standalone number should have freaked out. I was Not surprised by the reaction in the Treasury market. Was not surprised that 10-year yields on that day closed just below 4%, and we were down about at least 10 basis points that day. I mean, that didn't surprise me because we saw a headline number below expected, downward revisions. The unemployment rate rose. Now you can debate as to whether or not that's a weather report or not. The BLS said that the hurricane had just a marginal impact. But you had widening slack in the labor market, and wage growth continued to recede. So this was just a smorgasbord of very benevolent events as far as the Treasury market was concerned. Was it a recessionary statistic? Although I'm still in the recession camp, it's been a long wait. But no, but it was certainly a disinflationary report. And that's what the bond market had to see. And you see, the thing is that the non-farm and household survey came out exactly 2 days after the FOMC meeting. Now, I would posit that if Jay Powell didn't concentrate so much of his attention on the other part of the dual mandate, which is the labor market, where he talked about that incessantly from the podium, then maybe the market reaction wouldn't have been so acute, especially in the bond market. But he told you where his attention is shifting. And so that's what made the employment number so much more important. But it really reinforced his message that even without the economy collapsing, we are seeing widening disinflationary slack emerge in the labor market, and that's all you really have to know.
David, fold it into the stock market, which you do so well, and I want you to fold in the idea of nominal GDP comes in because inflation comes in a Rosenberg fashion. Maybe real GDP's quiescent or solid or comes in, and all of a sudden corporations are struggling for revenue growth a la Home Depot. Is that our 2025?
Well, it probably is, because what was important about Home Depot wasn't what they said about their current sale, the very weak guidance that they provided. That was really, I think, the source of disappointment today. And it's following a string of companies, primarily in the consumer space, which are really struggling. And all the eyes, of course, are on technology and the generative AI wave. And technology, call it over 30% of the stock market, a much lower share of the economy. And what's important, I think, from, I guess, a macro perspective, taking the cue from the stock market, is that the only sector among the 11 S&P 500 sectors this year that's in the red is consumer discretionary, which may be less than 10% of the stock market capitalization. It doesn't get that much attention because everybody is just focused on the sex that's provided by the technology sector. But discretionary consumer spending is 40% of GDP. And so what the stock market is telling you, for all the naysayers out there about, because the recession hasn't come, therefore it's never going to come. But you have a disconnect between the components of the stock market, their shares, and the shares that actually are in the economy. So the consumer discretionary space being the only sector down, but the dominant force in domestic demand, I think is a red flag as far as the economic outlook is concerned.
So, David, how do you view the U.S. consumer? I mean, I guess it's hard to even say there is a common consumer out there. There seems to be many strata out there. How would you characterize, consumer demand out there?
Well, everybody's talking about the K-shaped economy, but you are even starting to see some of the strains emerge in the higher end. And the higher end has been held up because they're not as debt heavy as low and middle income households. They're not as debt heavy, therefore not as vulnerable to the interest rate shock of the past couple of years. And of course, they benefited from the wealth effect from what the stock market has given them. And now the stock market seems to be topping out. But in the end, recessions are caused by slight changes at the margin. And you're seeing those strains really emerge amongst low-income households, which spend 100% of their income. And I think actually, the biggest bombshell was what Brian Moynihan said on Face the Nation on Sunday. Because, these bank CEOs, let's face it, they're normally a pretty cheery bunch. But he's talking about their sample size, of only 60 million consumer accounts,
Right.
and along with Wells Fargo, the other consumer bank. And he didn't just say that consumer spending is slowing. He said it's slowing sharply.
Okay.
And you have all these other economists, and I know they show up in your shows talking about, traffic at airports and traffic at restaurants and traffic at theme parks, everything's fine.
Right.
And that was laid to rest by Brian Moynihan, who said, oh, yes, for sure, traffic is strong. But here's the problem, is that spending per person.
Yeah, I'll take that
down.
And I'll also
by the way, traffic doesn't go into GDP.
Right, but David,
does.
to put a bow on this, and I want to get your market conviction here of what you're doing if you're not all in cash. But to Mr. Moynihan's point, revenue is price dynamics and unit dynamics. And so in the airline business, they're popping unit dynamics nicely. But the prediction here has to be a Rosenberg-like price drifts away. There's no pricing power, is there?
No pricing power, and there's obviously a bit of a disconnect. I've got to say, I'm not a conspiracy theorist, but the government data have been so far off the more anecdotal survey data, and of course what corporate executives have been saying. And what about the Beige Book? And I was actually heartened by the fact that at least Jay Powell gave some lip service to the Beige Book, which is the most comprehensive, albeit non-data, assessment of the U.S. economy that comes out every 6 weeks. And you're 100% right, Tom. Every single Beige Book this year, even during that temporary inflation blip caused by insurance costs beginning of the year that caused the Fed to sort of step back, every single Beige Book is talking about an ongoing loss of corporate pricing power. And of course, we talk about pricing power. It's not about levels, and the bond market does not respond to levels. It responds to change. And what's happening is that you see when the corporate sector were raising prices like it was nobody's business in 2021, 2022, nobody cared. Everybody was willing to accept the price increases in the consumer sector because we were flush with that $2 trillion of stimulus checks. But you see, all of a sudden, the stimulus checks are gone.
Right.
The savings rate at barely more than 3% is a fraction of the pre-COVID range of 7 to 8%. And all of a sudden, without the cash cushion, people see, look at these price levels. Now, the thing is that, and this is what I'm looking at, corporate profit margins are still in the top half of the historical range. So companies actually have the capacity to reduce their prices. I don't think we're going back to where we were 2 or 3 years ago.
Right.
But they have capacity to lower their prices in response to what's obviously a consumer revolt right now against these prices. And that, by the way, is when you build into a deflationary environment.
David, we're out of time.
I'm steadfastly bullish on the Treasury market.
Thank you. And we'll get the yield calls the next time around. A lot of people all of a sudden looking for Rosenberg-like yields. David Rosenberg, Rosenberg Research, can't say enough about his work. Seema Shah, who joins us right now. Seema Shah is with Principal Group. We're thrilled that she could join us this morning with a great perspective from London. Seema, I want to get to the flap at the moment, which is sort of the global wrap around the carry trade in Japan. But I want to bounce off what Lisa Mateo just said, which is people are considering layoffs. Are we just really setting ourselves up, a la Home Depot, a la Generous Motors and others, where companies are really going to start managing headcount? Is that what you feel in the air?
Hey, Tom. So, I mean, look, that is really important news if we start to hear more companies talking about layoffs, and it really is a concern. I would say that at the moment, though, I mean, I think what we've been hearing on the street and across the board is, yes, companies are revisiting their labor costs. It makes sense. You know, they're looking at higher refinancing costs, particularly with the funding wall coming up. And so as a result of that, they're looking at everything, and they have to, balance off any additional costs somewhere else. And the thing that they are looking at is appraising where on the labor cost side that they can pull back on. We haven't as yet seen layoffs, but we have seen snipping around at the edges, whether it's reduced hours, earnings, etc., but not quite the job layoffs at this point.
What sector do we watch to see that trend? The easy answer for Global Wall Street is the financial sector. But what sector would you pay attention to?
It's the financial sector, certainly, but it's really the consumer discretionary, because remember that the consumer side has been the key driver for the broader US economy. If you're starting to see pullback on that area, well, then that really does start to question the strength, the resilience of the US economy. So that's a bit, I think, which would be the really concerning side. And certainly any areas which are really interest rate sensitive, the bits that would be more cyclical and would be, I guess, a bit more of an advance warning that there's economic pressures building.
So, Seema, given that, I guess, you think about a week ago Friday with that jobs data really kind of spooked the market. How do you think the Federal Reserve is kind of leaning at this point?
So, and I think this is the big question that everyone is thinking through. So I think similar to, the first thing to remember is that, just as we are absorbing the economic data as it comes out, that is exactly what the Fed is doing. But I don't think they have any additional information on top of what we do. But what we can see, and assuming that the inflation data today and tomorrow are fairly well behaved, it means that they can shift their focus points to the other side of their mandate. Now, we do think that they will have to err on the side of caution. Maybe think about front loading some of those rate cuts, whether that's back-to-back 25 basis point cuts. If you have a worse labour market report come the beginning of September, then certainly a 50 basis point move starts to come onto board. But the thing that you're seeing already is that Fed speakers are not all unanimous in the idea that the labour market is slowing and that inflation is under control. So I think there's a bit of consensus building that still needs to go on behind the scenes.
And Seema, we had the manufacturing, I know this is a services-driven economy here in the U.S., 70% or so, but the manufacturing economy's weak. We had some weak ISMs last week. What do you make of that?
Well, it's concerning. I think with the ISMs, for the last year or so, I would say that they haven't been the best indicator of what's actually going on, certainly in the hard data. So we want to take that with a pinch of salt. But this is the thing with the US economy, and I don't think anyone's in denial about this, is that there really are pockets of weakness. It's definitely not the point. I don't think anyone's making the point that the whole US economy is looking really strong. So I would say manufacturing, segments of housing, they're the areas where you are seeing weakness. And to your point before, services is the main driver. So that's a bit that if that starts to turn and starts to topple, then actually the picture for the US economy starts to really, really deteriorate. The manufacturing side is clearly slowing. I think that has come through in a number of bits of data.
So where do you have nominal GDP? We're sitting here this morning in New York, Seema, looking at Home Depot with not shocking, that's the wrong word, but abruptly negative same-store sales numbers. Is that just an indication that nominal GDP not only under 5%, but can begin to threaten a nominal GDP growth of 3.9%?
So what we're seeing in our forecasts as we get through to the second half of the year is that you see GDP slowing down towards that trend level, somewhere between the 1.7 to 2.2% on a real GDP basis. So I do think, I think the Home Depot is a concern because we do typically look at that as a bit of a forward-looking indicator of what is building up in terms of strains amongst consumers. So it's one thing that we do need to really focus on and take notice of that news story. But I think that we should be expecting that, the US economy isn't going to stay, it's not going to stay, not going to continue to accelerate. I would expect that Atlanta GDP now tracker to be coming down as the month and the quarter progresses. But I think a trend level for GDP for the second half of this year makes sense, with maybe a further slowdown at the beginning of next year before Fed cuts start to really come in and second half of next year starts to look a little bit stronger.
So let me cut to the chase. What does the stock market do? If I've got trending, tepid, Seema, Shah, like we're going to get through the year, is there a way that equities manage to be resilient or even improve in price?
I think that they do. So I think that there's actually a window, actually a fairly long window where equities can do okay. Now, for the first month or two, I think it is going to be challenging because the market is going to respond to every single bit of data. And inevitably, across any bit of data, there's going to be pockets which are weak. So that volatility and uncertainty continues. But I think the key thing is this, in terms of a recession outlook, even if there is a genuine economic slowdown coming through, given the resilience and the balance sheet strength of households and corporates, is it likely that the Fed can't come to save the US economy with various rate cuts? So actually I put the chance of recession fairly low, which means that after a bit of volatility and pullback, I think the equity market can still eke out some positive gains as we get through 2024 and into 2025.
That's our first bull of the week.
Yeah, there you go.
Seema Shah doing it.
Hey, Seema, I mean, we've been talking about a recession for 2, maybe 3 years now. When do we typically, how often do recessions typically happen, and aren't we overdue?
So it depends whichever indicator you're looking at. But I mean, if you're thinking about what happens post-Fed tightening, around now is when you're meant to be in recession. So certainly with the SARM rule, with the jobs numbers, etc., maybe it all kind of falls together nicely that this is the time that we should be in recession. But if you look across the broader environment, we're not really seeing signs of that. The concern, of course, is always that once you see some layoffs, it becomes something which is self-reinforcing and it can unravel very, very quickly, which is why these news stories from companies announcing layoffs is really, really important. But as I said, as long as you have strong household and corporate balance sheets, then actually weakness in the labor market should not be able to mutate into that kind of hard landing.
Seema Shah, thank you so much. Principal Asset Management, their Chief Global Strategist. Greatly appreciate that. Folks, actually, when we quote PPI, Paul and I have no idea what we're talking about.
Nope.
McKee's in my ear telling me what to do. But the reason we're doing it is to give Sarah House time to digest the numbers, senior economist at Wells Fargo, an expert on this. Sarah House, does this PPI set confirm disinflation in place?
I think it confirms that we are seeing that disinflationary trend still underway. So we did see, I think, some improvement in terms of the headline and the traditional core. Although if you look at what we refer to as the core in the PPI, so that strips out, in addition to food and energy, trade services, which are measured in margins, that did come in a little bit firmer than expected, which I think is consistent with slowing inflation, but it's a gradual slowing.
So there's a summary for you, and the summary and the support we get on economic indicators, always with Commonwealth. Our economic indicators with Sarah House today, brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to Commonwealth.
Sarah, what do you think the Federal Reserve, how do you think this Federal Reserve will kind of look at these numbers this morning in totality?
Yeah, so I think they'll be digging into the details in terms of what specifically feeds into the PCE measure. So I think like economists and like a lot of market participants, getting a lot more dialed into the granularity of the PCE and CPI combo, what it means for the Fed's preferred inflation measure. But I think they'll be looking at a number that still seems like it's consistent with the first quarter's flare up in inflation being just that, a flare up, and again, not really derailing the disinflationary trend that started last year.
So give us your thoughts here, Sarah, about this economy here. I think a lot of folks are concerned that the Fed is too late in cutting rates, and that the risk of inflation, recession, are really there, and maybe the Fed's not recognizing them. How do you think about that?
Yeah, so when I look at the labor market data, and this isn't just about the July jobs report that we got a little over a week ago, but really the array of jobs market data, which shows that not only are conditions softening, but they're really back to where they were in kind of pre-pandemic, and in some cases even mid-2010s. I think that you are seeing that downward momentum is concerning, and I think the recession risks have risen. But the good news is that the Fed has room to dial back the level of restrictiveness that we're seeing, and I don't think a recession is a foregone conclusion. But the Fed needs to get going in order to support the labor market, especially given that I think we've seen that disinflationary trend in place and no longer as much of a concern.
Let's get up to CPI tomorrow then, Sarah House. I mean, you've got a model on an Excel spreadsheet, one part real GDP and one part your measure of inflation equals nominal GDP. Let's go through each part right now. Where are you forward on real GDP 12 months?
Yeah, so we're looking for real GDP to slow, so probably somewhere closer to 1.5%, 2% over the next 12 months. And I think that is consistent with the slowdown that we're seeing in the jobs market, what that means for consumer income. But with inflation slowing too, that does mean that.
So what's your inflation number that you're overlaying on a 1.5 to 2, 1.75% center tendency?
Yeah, so when you're looking at core PCE, probably somewhere right around 2%, maybe 2.25%. So further progress, not quite all the way back to the Fed's 2% target, but we think against the labor market, good enough as far as the Fed's
This is critical.
concerned.
So you're talking about modeling a center tendency sub 4% nominal GDP.
Roughly 4%, yeah, given that inflation's probably going to be a little bit above.
I'm just trying to make some news here. It's a slow day here. Sarah House, Wells Fargo. With us. Sarah, what are we going to see tomorrow with the CPI at 8:30?
Yeah, so we're looking for a 0.2% increase on both the headline and the core. So that's in line with the consensus. But I think the details are going to be really important. So to what extent are we still seeing outright goods deflation? And are we seeing more progress on the services side, both in housing, but also the non-housing services that have been such a concern for the Fed?
So, Sarah, I mean, I guess, one of the issues here is the consumer. We're also going to hear from the consumer later this week. How's the U.S. consumer out there from your perspective?
Yeah, so the U.S. consumer is hanging in there, but we do think that households are increasingly constrained in their spending. So credit is more expensive, harder to get, so we're seeing less use of it. At the same time, not as much of that excess savings from the pandemic. And so it really comes down to the jobs market, and there with slower job growth, slower nominal wage growth, that means slower income growth as well.
Right.
And so we think that's where you get that slowdown in consumer spending is consumers just don't have as much to fall back on. And so they're getting more cautious as a result, but you still have positive real income gains. And so that's keeping overall spending in positive territory.
Sarah, fold in your work, economics, into the Wells Fargo yield guess. And where I want to go, I mean, I could go 10-year nominal, but I'm going to go the 10-year inflation-adjusted yield. It's in 2 beeps. It's in 5 beeps over 2 cups of Starbucks black coffee, 1.77%. How much down can real yields come when you model in a maybe 4% nominal GDP?
Well, I think if you continue to see the improvement on the inflation side, they can come in a little bit more. And I think especially if you get the Fed cutting, which we think that they'll actually cut pretty aggressively here in the rest of the year. So there's probably still some room to go, but we're not going back to the pre-pandemic days by any means. So we think that Fed easing is going to be more recalibration and not a move to accommodativeness.
Thanks so much. Greatly appreciate that. Sarah House with us, with Wells Fargo, their senior economist. Your daily front page is the Lisa Mateo Hour. Lisa, what do you have?
All right, we talked about how artificial intelligence, like a lot of college kids are taking courses in it, but it turns out a lot of older Americans, we're talking about seniors, they are starting to take classes in artificial intelligence. I mean, think about it. They've gone through a lot of transitions, right? You had the icebox to the refrigerator, you had radio to TV, they went through all these transitions.
So you think in my youth I had an icebox?
I didn't point to anyone.
I don't have a clear memory, but I have a memory of my mother waiting for the ice truck. To come down the street.
Okay, so you're in there. Yeah. All right. So
here's Barbara Winston. Yeah. I saw ice boxes turn into refrigerators. That is how long I've been around.
See?
But I think this is probably this being AI is the greatest technical revolution that I will see in my lifetime. That's saying something because Barbara Winston is 89 years old.
Exactly. And they're interested. I mean, think about it. Like, there are some things like these classes at senior centers now, it could help them because it makes them easier to get things like medical appointments. Like AI can help you with that. But it's also teaching them about the other side of it, like being susceptible to misinformation, like deep fakes. And seniors are very susceptible.
Yeah, I think the scam thing is real. And on social note, it's percolating with Zelle. The banks, the government's looking at the banks, as they should be. It's, I think, not the bank's fault, but the fact is all this new technology leads to people be careful out there.
Yep.
Yeah, most definitely.
I get stuff all the time.
All the time, yeah.
It used to be simple. It was a letter from Nigeria, and you could
Yes,
tell it was
exactly.
from Nigeria. It's not as simple as that anymore.
No, you get them on your phone too. You
Yeah.
get these weird text messages.
Kids get them.
It's
What's
crazy.
this?
It's crazy. We were just talking about the Olympics, right? But you remember what was missing from this year's Olympics was baseball, right? And softball, have to point that out.
Okay.
But it's coming back in 2028, right? It's in Los Angeles. So MLB players want to play, but as you know, the league doesn't let them. So it's kind of this back and forth about what's going on. So
Interesting.
they never really allowed them. One thing, it coincides with their season, so they would have to shut down, right? I mean, but players want to play. You have Shohei Ohtani. He told Sports Illustrated he wants to play. Bryce Harper's been fighting for it. Aaron Judge says it would be a dream to play in the Olympics. But could that shut down, what could that mean? I mean, they're already cramming, you could think, 162 games into 180 days. If
Hockey
they prolong
tried
it, hockey tried it,
Winter
yes.
Olympics.
They went for about 2 weeks, they went dark.
And people got injured.
And that's the other thing, injuries. That's the other thing. I mean, and then if you, let's say you postpone it, you extend the season, then you're competing with the NFL.
You two are way more into this than I am. Did we lose breakdancing after the Paris
Boy,
Olympics?
I think that might have
Is
had
that
its
decision been
flash in the
made
pan
yet?
there.
You
Oh, my
didn't
God.
like it?
Oh, Snoop was up in the stands nodding off. He was so bored. What else do you have this one?
This one's interesting. The San Francisco Fed says middle, low-income Americans.
Hold on a minute. Oh, we got a problem. Excuse me. You got to tell Ari on YouTube when we talk about baseball, we lead with the Red Sox. We need images, even if it's about Los Angeles. We show the Red Sox first. Okay, next.
New rule. Okay. San Francisco Fed survey, middle and low income Americans, they're running out of disposable cash, but they're on track to have less than they were on pace before the pandemic. So here's what that survey showed. Just to break down the numbers, the top 20% of households by income, they saw their liquid assets. So we're talking about things like cash and funds and savings, checking, money market accounts. They rose sharply in 2020, early 2021, but then they dropped. They're now about 2% below what would have been about the pandemic's impact. So it's even worse for those households that represent the lowest 80% by income. So it's just showing how much they have as far as
I
cash.
can't say, and I'm so glad you did this, I can't say enough about this, folks. I follow and there's people that keep this, the percent of Americans living paycheck to paycheck, to me, is a social statement. And it's shocking. I mean, it's just
and you're seeing it in some of the earnings numbers we've heard from a lot of the consumer companies. From the fast food companies all the way across the board. Okay.
Yeah, most definitely. And then this is the last one, a music one. Okay, we've been talking about vinyl all the time. Everybody's going into vinyl.
Killing me.
But now it's about audio cassettes. That's what the kids are doing.
Saw this.
Gen
Are
Z.
you kidding me?
Yes, they are listening to audio cassettes. The reason why you have a lot of these stars, they're putting out their new music onto cassette, like the Musgraves, Taylor Swift, Olivia Rodrigo, Dua Lipa, Ariana Grande.
On cassettes.
On cassettes.
I want to listen to Vampire on cassettes.
Yes, because they're saying, well, here's the thing.
Okay.
When you compare it with vinyl, the kids are saying that it's cheaper and it's more portable.
That's what we said back in the 70s.
Okay.
So it's the same.
I could go all day on this, but I'll give you one story. Brockton will understand this. Brockton's our producer. He'll understand this. If you can sit in the Burger King at I-24 and 495, and you bribe your kids by feeding them Burger King, and you sit there with a pencil turning the cassette wheel because 1.5 foot of tape's out on your lap in the car.
Yeah, that's how you do it.
That was technology back then.
That's how
And
you
they
do
want to
it.
go back to that.
They want to go back to it. They're pushing their parents. The parents are going into the attic, the garage. They're trying to find the boom boxes so the kids can play the tape.
Does anybody in the control room have
No.
a turntable in their house?
No.
You do.
Oh, I don't have a turntable.
You do. You're probably playing
see.
Jay Giles' band, right, Brockton? Yeah. I mean, I got Jay Giles vinyl.
Well, the first album I ever listened to end to end was Born to Run on my sister's cassette player in her bedroom. I was not allowed to take the cassette player out of the bedroom, so I had to sit on her floor on the shag rug, teal shag rug, 75, listening to Born to Run cassette. That's how good that was.
Look at that memory.
Boom.
Oh, my first
Bringing it
vinyl
back.
was Donnie and Marie, Golden Coconuts. That was my first vinyl.
I mean,
Gotta love it.
a seasoned news reporter, Donnie and Marie, Lisa Mateo.
Loved it.
All right.
This is the Bloomberg Surveillance Podcast. bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.